Hi, I'm Ashley with Campbell. Thanks for investing your time to help your community be a great place to live. Before you watch the video, make sure to click the subscribe button so that we can help you make educated decisions as a board member.
Good afternoon, everyone. My name is Evan Bradley. I am the Chief Financial Officer for Campbell Property Management and one of the 5 owners of the company. I'm also a licensed CAM, and I work very closely with some of our largest clients on the major issues facing their associations. For those of you who may not be as familiar with Campbell, we've been in business since 1953 and manage over 400 HOA and condo association clients from Dade to St. Lucie counties here in South Florida. Our guest speaker today is going to be Paul Mack, Mack Mack Waltz Insurance Partners. He is an expert in the field of HOA and condominium insurance. So Paul, would you like to say a few words about yourself and your company?
Yes, I would. Thank you, Evan. Thanks for having me on here today. Mack Mack Waltz and Assured Partners has approximately 3,000 communities here in Florida. I've been doing this for 30 years, and I specialize in writing community association business. And we got a lot of things to talk about today.
Thanks, Paul. Just a reminder, this is not legal or insurance advice. If you do need advice about your specific association or your specific renewal, please reach out to your agent and or your attorney. If you don't have an agent, I'm sure Paul will be happy to help you. Also, please, if you ask questions in the Q&A today, please make them relevant to the course material being presented. Very specific questions about your individual condo or HOA situation are going to be beyond the scope of what we can answer today. So with that, we're going to go ahead and get started. We're going to go a little bit through the basics of association insurance and how it works. We're going to talk about the state of the market. I wish I had better news, or Paul had better news, but I think we all know what's going on out there, what to expect for 2022 and really 2023 renewals, where we're headed now. What, if anything, can be done to reduce rates, and how to communicate and plan for these increases. And then we'll take questions with whatever time we have left. So the basics of associations insurance. So Paul, what types of insurance must the association carry?
So there's several policies that are sort of the standard or required insurance policies. And the biggest one that everybody struggles with right now is the property insurance policy. So that covers fire, lightning, wind. If you're a condominium, covering, the outside shell of the building. If you're an HOA, clubhouse and auxiliary property like guardhouses and such like that. And we also have a liability insurance policy. So the property insurance policy covers first party losses like fire and lightning and wind. General liability insurance picks up third party lawsuits and covers defense costs if you're sued from a slip and fall, say, for example. And then we also have director's insurance. So a director's insurance is like a management malpractice policy that covers the Ds, the directors, the officers, and the entity from issues such as a bad decision that a board could make. And we have an umbrella policy. So typically when you buy director's insurance and liability, slip and fall liability insurance, there'll be a limit of $1 million, and the umbrella kicks in over and above when those limits are exhausted. And then we also have a crime insurance policy, or sometimes known as fidelity, covers all the funds that the association is holding, money that belongs to the members in case it's stolen. Those are the primary policies that we have in an association's portfolio.
Okay, so we get this question a lot, Paul. Can an association be self-insured?
We do get that question a lot. Very difficult. It comes up all the time because rates are so high. We want to know, associations want to self-insure. So self-insurance is a process. And unfortunately, it's not feasible for a lot of reasons, but to cover the top reasons, if anybody has a loan in the building, a lender is not going to accept self-insurance because there's a lot of risk tied up in a tight area. And if a hurricane or a fire occurs, the association is going to have to come up with a lot of money to do that. So it just isn't feasible. Also, from the standpoint of a director making this decision, even though insurance is expensive right now, if you could have insured it and had an insurance company pay for a loss, and now the owners are looking at a stiff assessment, those owners could be sued for that decision. And that directors and officers insurance that I just mentioned isn't going to cover a willful decision to not buy insurance. So I think those are the two top reasons why we don't really see it happen much.
Well, I think it's important to point out too, most association documents require it. So you'd be in direct violation of your condo docs, most likely. And there's provisions in the state statute as well that address the need to insure. So there's a lot of reasons why you really cannot self-insure. So the next question that comes up a lot is what is the role of the insurance agent, and how do these policies get bid out or shopped? How do people know they're getting a good deal if they only have one agent, I guess?
Right. So this is a really important subject for most of the listeners here to understand, because an insurance agent isn't the bidder of insurance. So the insurance policies are between the association and the insurance company. The agent's role is several things. One, to gather information, create a submission that goes to these insurance companies, send it to the right insurance companies, and then once proposals and insurance company quotes come in, look at them, see what exclusions exist, try and negotiate the best deal that they can for the association, and then help the association make the best decision possible. We're not always in this really hard market that we're in right now. And when we get multiple insurance companies that are bidding, it's important that you pick an agent that understands how to write community associations so they can go to the right insurance companies, help you make the right decision, help you navigate through the exclusions, the limitations, and all of those things that could affect the association when there's a loss. But it is really important to understand that the agent isn't the bidder, because a lot of associations say, well, you need to go out and get another bid. We need to go out and talk to an insurance agent. And getting into the next topic there, where how is it bidded out? Most insurance companies, with very few exceptions, will only accept a submission from one insurance agent. So it's the insurance company that's bidding it. So how do you know that you're getting the best deal? Well, you can shop for insurance agents. You don't have to pick one insurance agent. You can interview 3, 4, 5 insurance agents, and then choose the agent that you think is going to do the best job, who's going to provide the best service, and is going to explain what you're getting, and is the right insurance agent for your community.
Right. Can you have 2 agents at a time? Somebody asked. I think you kind of covered that, but what happens if you try to have 2 agents?
Yeah. What happens, especially in the current environment we're in, is there's not enough room, because an agent, I'll go in, or another agent will go in, 2 of us, and we'll both send submissions, and we're both going to the same places because there's so few options right now, especially for property insurance. So what happens is the first agent in is going to be the agent of record. And now the association has the ability to change that agent, but you don't want to be jockeying it back and forth because you want this agent to negotiate a better deal. Remember, the insurance companies are the bidders, not the agent. The agent is the conduit. The agent is helping you understand it. The agent is creating the submission and sending that. So if an insurance company says, well, we already have a submission from agent X, then you're not going to get a better deal. I think the greatest value an agent has is his or her expertise and the service and the attention that they're going to give to a community, helping them understand what they're getting.
All right. This question comes up a lot. We hear the terms admitted and non-admitted down here when you're getting bids on insurance. What's the difference between an admitted and non-admitted carrier here in Florida? 2 big differences. Admitted carriers are subject to a stricter degree of regulation when they write their insurance policies. If they want to put an exclusion or a limitation, or they want to change their rates, all of that has to be filed and approved by the Department of Insurance. So it provides a higher level of security or regulation to the consumer. So obviously, when you can choose an admitted over a non-admitted, that's a significant advantage. The other big advantage is that the admitted carrier participates in what's called FIGA. FIGA stands for the Florida Insurance Guarantee Association. So if the admitted carrier was to go bankrupt, then FIGA would stand behind that policy
for a community association policy up to $300,000 per unit. So another significant advantage. And in the present market, we do have admitted carriers that write, but we also have non-admitted carriers that write. And there's a reason why non-admitted carriers write, and there's a reason why they're not subject to that higher degree of regulation, because in taking riskier, writing riskier policies, such as a community that has a lot of claims, you're not going to get an admitted carrier to do that. So a non-admitted carrier needs that flexibility in order to be comfortable writing a policy.
All right. Let's get into the state of the current market a little bit. I mean, we've seen increases every year. They've been large increases. Why is that happening?
Well, we're seeing increases right now for several reasons. I mean, everybody's aware of the amount of storms that we've been impacted by, whether it be in Florida or in Gulf states. Other natural disasters that these insurance companies have experienced are just creating an environment where they really don't want to take risk in catastrophic prone areas. And particularly here in Florida, we're seeing a big increase because of the environment that we're in. And we're going to get into what the legislature could potentially do here with why there's so many lawsuits in Florida. But the present environment is making it very difficult for insurance companies to make money.
Right. So a lot of people asked about Surfside. Has Surfside impacted the market, continuing to impact the market?
It has had a big impact, particularly in the area of umbrella catastrophic insurance. So as I mentioned to you, those associations, most associations, if not all of them, buy an umbrella policy. So that primary $1 million for slip and fall or management malpractice, when that limit's exhausted, then that umbrella kicks in. And typically those limits are high, at least 5 million, but some are buying 50 and $100 million. And it's relatively inexpensive considering what you're getting. Those carriers have some carriers have basically, folded up shop here in Florida and left altogether. And it's also impacting underwriting. Insurance companies are wanting to see engineering reports on a lot of risks in order to consider writing a policy.
All right. Hurricane Ian, obviously, we're all familiar with over on the West Coast. How are those claims pouring in, and how's that impacting the market?
Yeah, right now the estimated Ian figures are somewhere between 35 billion and 73 billion. That's the best guess of what the industry is going to pay for insured losses. So obviously having a big impact on our marketplace right now. And we've already lost 6 insurance companies in 2022 to bankruptcies. Big insurance company that we all do a lot of business with, their stock 2 years ago was $300. I haven't checked it this week, but it was less than $1. And this is not helping.
Right. All right. We all are familiar with inflation, but specifically, how has inflation impacted the rates? Maybe not exactly what people think. How are you seeing it impact rates?
Right. So when we buy property insurance companies assign a rate, and that rate is assigned per $100 of every dollar that an association buys for their building insurance. So insurance companies, in order to make actuarially sound premiums, they have to assume that you're buying at least 80% of the full replacement cost. And we've seen a big spike in construction costs. So if an insurance company charges a rate of 80 cents per $100 of insured value, and the association isn't buying enough insurance, then in theory, they're not collecting enough premium to substantiate the risk that they're taking. So they're looking very closely at the insurable replacement cost, what we call the TIV, total insured value, that an association is buying for all of the improvements or assets that are on an insurance policy.
Right. So basically, because in construction costs have gone up so much, these appraisals have gone up so much, in terms of what would it cost to rebuild a building, And that alone, even if the rates had stayed the same, would drive up the rate the condo pays, I think is what you're saying.
That is correct. And rates aren't staying the same. So we're seeing increases of, minimum 30, 40% right now, upwards of 50, 60, 70%. And then when you add in the inflationary factor of, at least 5 to 15%, that's compounding that increase. So
Right.
it's becoming very significant increases that we're seeing, particularly
Right. So then we get into IRMA claims, which, believe it or not, are still happening. So how has that affected the market?
Still, we still have IRMA claims. I mean, I have one right now that is still in litigation and still in an IRMA litigation. So it is having a big impact on the market. In fact, lawmakers in Tallahassee right now are dealing with, this is probably the top issue, where you have all of these, I'll call them free roofs, so to speak, where roofing contractors go out and solicit door to door. And we'll get into some of the issues that we're experiencing, but still having a great impact on the market. I'll give you a quick statistic. So from 2013 to 2020, out of all the money that insurance companies paid out for losses in Florida, 8% of that money from litigated property insurance claims went to the policyholder. 21% of that money went to the insurance company's defense. So that leaves 71%. Where do you think that money went to? That money went to plaintiff attorneys. And that's what's having a great impact on the market right now.
Right. I heard another statistic that we're about 9% of the insurance premiums nationally, but something like 75% of the litigation.
Yeah, that number's 8 to 9%, and I've heard 76 to 79%. So think about that number. 8 to 9% of all the claims nationwide occur in Florida. That's a small number, but 76 to 79% of all the lawsuits are right here in Florida. So that's another big indication as to what the problem is. And lawmakers are in a tough place, because what lawmaker wants to pass a law that's going to put the insurance company in a better position to defend the claim against the consumer. But we've reached a point where, obviously, how are the consumers benefiting when only 8% of the money that comes from litigated claims are going to the policyholder, and 71% are going to their lawyers?
Right. Roof and roof age has become an issue here recently on renewals. What can you tell us about that?
Yeah, roofs and roof condition and roof age are a huge issue for all the reasons that we just discussed. So an insurance company is looking at this and saying, well, if we know these roofs are in good condition, and we can document that, then we're going to be more comfortable, because most of these litigated claims are on buildings where the roofs were older, and it's much easier to make a case of having the insurance companies pay for these roofs. So they have really doubled down on underwriting, in so much as they want to see roof inspections for every single building. They want to know what useful life is left. Technology has enabled these insurance companies to do a lot with being able to see what these roof conditions look like, drone inspections, satellite imagery, and they're looking hard at this, and almost every single insurance company is doing it. So, a lot of what comes up, and a lot of what our associations are telling us was, hey, our roof isn't leaking. Well, the insurance company isn't concerned about it leaking. And I know that many people listening here feel like their roofs are in good shape, but that doesn't eliminate or reduce the risk to an insurance company, because when the wind blows, the fact that it's leaking is irrelevant.
Right. And we talked a lot about property insurance so far, but general liability, umbrella, D&O, are other lines of insurance seeing the same type of rate increases that property is?
Property is definitely driving it, where, I'm not seeing hardly anything less than 30, 40% right now, and upwards of, 50, 60. And in some real bad cases, it could double or even more. But those are kind of far and few between. Liability, it's still a bad environment for liability. If you take property liability and umbrella, you take those three policies in a typical association's portfolio, and you're more than 90% of the cost. D&O I think is fairly stable, but it is going up. Fortunately, it's not a significant cost, so that's not a major factor. But the three big ones: liability, general liability, and umbrella, are going up. We're seeing 30-40% increases there. That's pretty normal. Something called social inflation, which is the cost of these settlements now are rising dramatically. So if the cost of claims rise, the cost of premiums have to follow. And it's a very difficult environment here. We have a lot of slip and falls. We have a lot of attorneys taking on those cases. So the results and the performance that insurance companies experience writing community association slip and fall insurance is not good.
Right. We did have a little bit of a dip in the market. This is a year old now, so this line has gotten a good deal higher. I'm sure it's over the 1.2 million mark now. But put it in perspective. Back in the early 2010s, rates had, for this example, condo had risen quite a bit after Wilma, and then approached approximately the $1 million mark. And then we did have a lull where we had a soft market. But then, starting around 2019 and obviously in 2021 and now 22, we should probably be somewhere up here. We've really seen a spike back up in rates. But the point of this is rates can come down, and they have come down in the past. Any other thoughts, Paul?
Yeah, if we took that line back, you would see a very up and down cycle. I do believe at some point rates will hit a plateau and maybe stay there for a short time and then take a dip, dependent upon what we do in the environment to create competition. I think that's a critical piece. If we can go back to a robust market where we have insurance companies that can exist in this environment, we will go back to some competition. And I hope that's what lawmakers are trying to accomplish here while they're in session.
Right. So what should you expect as we go into 2023, Paul?
Yeah. I'd say value, as you've got it written there, valuations are top of the list. Every single insurance company writing property are looking at valuations. So, we're required as community associations to get insurance appraisals done every 3 years. And sometimes the insurance companies are really throwing those out the window because they're just not realistic with the environment. So the insurance company will say, if this is what you want to apply for, we'll give you that limit, but we're going to do our own valuation behind the scenes, and we're going to charge you rates based on what we think the replacement values are. So I think that is top of the list. And next on here, the re-underwriting is key. We talked about roofs, also 40-year inspections. They want to see engineering reports. One carrier, even though this milestone, they're not insurance or associations aren't required today to have these. They won't consider it unless they have some sort of engineering report. So it is a big deal. And going back to where your agent has value, making sure the agent is asking the right questions so that when they present a submission to the marketplace and insurance companies that are willing to do this, the association is put in the best position possible. It's critical that all those things that these underwriters are looking for are addressed and explained to them to try and make them comfortable in this very difficult market.
Right. I mean, I think you've hit on a couple of times, but just to drive it home again, I mean, what type of increases are you seeing on the property side going into the next year?
In very few cases, less than 30-40%. That seems to be sort of a minimum right now. Anywhere from 40 to 60 or 70% is kind of where we're seeing most of them falling. And then there's the extreme cases where an association was really fortunate to have an insurance company that was charging below market rates, and now that's ending, and this carrier is terminating, and now they've got to go to the market. Now they've got to make up that deal that they've had and get back up to market, and oftentimes it's going to be a big leap to have to go from below market rates now and now getting insurance. New capacity is at a premium. Those big cases where we see are also associations that their valuations are too low, And insurance companies are saying, we're going to value this where we think it is, and then just make it up rate wise. So what that does is just inflate the rate. And ultimately what it means is an increase in costs.
Right. And are you seeing outright declines of some communities?
Many, just because these insurance companies right now are struggling to get reinsurance. So reinsurance is insurance for the insurance company. And those prices that, most companies that are writing property here in Florida are the smaller companies. So they can't take on the billions and billions of dollars of exposure that they've written policies for. So they lay it off to these big reinsurers. So the big reinsurers are coming in, they're cutting the capacity they're giving to these carriers that are writing. They're raising their rates because they're exposed. And that's the underlying issue that we have here. But to your point, we're getting declines because they're not able to take more risk. They need to take less risk. In fact, they're shedding policies. So where do all these associations go that are being canceled? There's very, very few. Citizens has blown up in the last couple of years here. The statistics are they had, in January of this year, they had 760,000 policies. They're up to 1.13 million now. So they're going there because there's no go, and lawmakers are having to deal with that as well, because that's risk to the taxpayers if Citizens has a loss that they can't pay.
Right. And now you had brought this up earlier that some of these carriers are putting in more strict co-insurance provisions. We have an example on the next slide, but
yeah,
at a very high level, kind of what is the idea of co-insurance and why do people need to be aware of that?
Yeah. Yep. So you want to go to that slide and we can kind of go through that, or do we want to cover that?
Yeah, we can go right over to here. So
yeah,
this is the financial example. Remind us again what the purpose of it is.
Right. So as I mentioned to you, insurance companies charge a rate per $100 of insured value. So what they do is they have to assume that we're buying the correct amount of insurance to make the premium that they're collecting commensurate to the risk that they're taking. So a co-insurance clause is put into a policy to protect them in the event that valuation is incorrect. And the example here, if we have the value of the property determined to be 15 million, and the co-insurance percentage or the co-insurance requirement is 100%, and they're actually insuring it for 10 million, well, we're roughly 1/3 off, right? So they're going to deduct, for simplification purposes, 1/3 off of the claim as a penalty. So if you have a claim that is $1 million, you're only collecting 66% of that. You're getting penalized 1/3.
Right. So I'll kind of step people through here. So, $1 million value of the property is determined after the loss. That's key, after the loss, to be $15 million. That was what the replacement value should have been. And you had a co-insurance percentage 100. That means you were supposed to insure 100% of the value, but your property appraisal came in at only 10 million. Maybe it was 2 or 3 years old or something. If you have a 5% deductible for named storm, you're already going to have to pony up 500,000 out of pocket because that's your deductible. And let's just say the loss was $1 million. They're going to say, okay, you should have had 15 million of insured value and paying your premiums off that, but you were only paying off 10 million. Therefore, you were only insuring 2/3 effectively of your full value. Therefore, we're only going to give you 2/3 of the loss. So your $1 million loss gets multiplied by the penalty, so 66%. So they say, okay, we're only going to pay out 660,000 or 2/3 for round numbers of the loss that you had. So now your $660,000 insurance premium, you have to now take off the deductible. So now they're only going to pay out 160,000 on this $1 million claim. Without co-insurance, you would have gotten 500,000. That's $1 million less your $500,000 deductible. But because of the co-insurance provision, you're now going to only get 160. So you lost out on $340,000 of insurance proceeds due to the co-insurance penalty. And it is a little bit complicated, but you have to be very aware of that.
Right, you do. And most insurance companies now are putting co-insurance. When we had a robust market and we had lots of competition, we as agents could negotiate what's called an agreed amount clause. So the agreed amount clause says that the insurance company and the policyholder both agree that at the time the policy's written, because you hit the nail on the head by saying that the insurance company does their own appraisal at the time of the loss, which is not good for a policyholder because you'll never know what the potential effects of a co-insurance clause is until it's too late. So an agreed amount clause will eliminate this uncertainty, but it's almost impossible to get unless the insurance company says, well, we want you to insure it to what we think the valuation should be, which is probably going to double your premium.
Right. So I'm sure I'm sure everyone on the call today wants to know, how do we reduce rates? Building improvements is maybe, the one thing that people actually have control over in this market. So what are some things they may be able to do there?
Well, looking at deductibles where the deductible thresholds are, particularly in the windstorm area, is probably the biggest impact that we can have. Unfortunately, many renewals that we're seeing, not only are they hitting them with a giant rate increase, but then they're just taking the deductible up as part of the deal. So they kind of take that off the table. We just had one that I presented last night that was Citizens, and the association could save, $40,000 by going from a 3% deductible to a 5% deductible. But, I don't think you can just look at the dollar savings. You also have to look at the risk you're now taking. And is it worth it? If you're saving $40,000, but now, you're raising your deductible from 3 to 5%, that's a big increase in the amount of risk that you take. So, boards have to be thoughtful about the savings, and is the reward worth the risk? But Evan, it's hard. Hardening the buildings and doing those things and making sure the buildings are in good shape. Choosing an agent that can help communicate this information to the marketplace, it helps. But right now things are trending so much higher that it's hard to stop the bleeding and slow down what these increases are. A lot of associations say to us, hey, if we replace the roofs, how much are we going to save? And my response to that is, it's going to lessen the impact of an increase.
Right. Another one, talk a little bit about impact glass. Some older buildings have had most or almost all of the units go to impact glass across the whole building. Does that make a difference if they can get everyone on board?
It does, because whatever limited capacity is out there in the marketplace, they're looking for the better risks. And obviously, when you harden the buildings and you do that, that makes their risk a little better. So they're going to take a shot. There are still companies willing to write. They want their pound of flesh for the risk. So anything we can do to mitigate that will bring down that rate. So it does help. I think people's expectations have to be in the right place where, oh, hey, we're paying, this level now, we're paying $200,000 and our rate is, X dollars. We're not going to save money from where we are. Everything's going up. So again, it should lessen the impact.
Right. So, communication is key. From a management perspective, how should you guys be communicating the change in the insurance market, the increases in your budget? In our experience, it's early and often. Get the word out. If you have a community newsletter, if you have monthly board meetings, if you have a manager's report, put out to the people what's happening. Link to some articles that may be available online or through Campbell's newsletter about these increases, so people can read for themselves what's happening in the marketplace. It's bad enough to have an increase. People don't like to be blindsided by the increase. So try to communicate early and often. If you do have a big budget meeting or a big insurance increase meeting, invite the professionals to help deliver the message. People like Paul can explain the market and answer the questions better than any of you on the board. Let them be the bearer of bad news and let them be the expert to answer all the questions from the community, so you don't have to bear that burden. And at the end of the day, I think it is important to remind people that live in your condo, particularly, Condo insurance is still a great deal. I ran the numbers on a waterfront condo that we managed in Broward with a $1.7 million insurance policy. They have 1,100 units. You'd work out the math on that. It's a little over $1,500 per unit to live on the ocean here in South Florida. You know, a comparable single family home in this market is anywhere from $6,000 to $12,000 to insure the same risk. So you are still getting a substantial discount on a per unit basis over a single family homeowner when you live in a condo. So although these increases year over year are a lot, there's still nothing near what some of your peers are paying for the same type of insurance. Anything to add there, Paul?
Yeah, I think, you know, you put it in perspective when you look at the single family rates. You know, it is still a, you know, rates have been so low for so long that it's hard to take these rate increases, and you know, we realize that some people are really struggling with this. And to your point, early and often, I couldn't agree with you more. You know, nothing worse than an agent not communicating to their clients that this is coming. And time and time again, we see, you know, with no warning, the premium's going to double. And I think then that goes back to choosing an agent that is going to be committed to communicating with you. Oftentimes what I will do is I'll put together a timeline, what you can expect and when you can expect it. And, you know, it might come down to the wire to get everything done and bound and firm, but, you know, nobody is going to get a double price at the last minute and have no idea it's coming from us. And I think that's critical to keeping, you know, residents informed.
Right. All right. That's the end of our presentation. We've got some good questions here in the Q&A, so I'll work through these. First one is from Jack. He asks about layering. What is a layered policy and how effective is it?
Yeah, great question. That is, and we talked about admitted and not admitted carriers. So what happens is an insurance company will not want to take an entire risk of a community's portfolio. So let's use the example of a community that has, you know, 10 buildings, each building valued at $2 million. We've got a $20 million total insured value. An insurance company will come in and write the primary $2 million of that, or $5 million of that risk. And then we build a tower. So we got a carrier that's doing the bottom 2 or the bottom 5. Now we go out and we build, you know, 5x the 5. Now we're at 10 until we reach that valuation. So we layer a program or we build a tower. It's all kind of the same thing, put in there by non-admitted carriers, and very common here in Florida.
All right. So Donnie says, it seems like we only get proposals within about 30 days of policy renewal. Is it possible to get it sooner?
You won't get a firm offer less than 30 days. In fact, in the current environment we're in, you know, it could come down to the wire, particularly with a layered program or trying to get something done that has losses, significant losses or frequency of claims. But communication is the key. So if your agent is communicating with you saying, here's where I'm at so far, here's where I think we're going to end up, then there shouldn't be any surprises. But the short answer is you're not going to get any firm quotes any further out than 30 days.
Right. So Gene asks, what's the added value of a boiler and machinery policy on top of the property policy?
So a boiler machinery policy is also known as an equipment breakdown policy. And our property insurance policies cover fire, lightning, wind. Our equipment breakdown policy or our boiler machinery policies cover sudden and accidental mechanical breakdown, such as electrical arcing. Lightning hits the building, that's going to be covered by the property policy. Lightning strikes off the premises, causes an electrical arc, that's not covered by the policy. That's going to be covered by an equipment breakdown policy because electrical arcing is going to be part of that. So that's a common example that we see. And a lot of buildings have a lot of mechanical equipment, elevators, fire alarm systems, cooling towers, that sort of thing.
All right. So Joe asks, do agents charge different rates, or markup? In other words, could I get a discount with a different agent, I guess?
No, Not common, in a world where a lot of agents we're larger. Some agents are publicly traded brokers. Others are owned by very large private equity. There's disclosures in there about how much money agents are making. We're all paid pretty standardized commissions by the insurance companies that accept the policy. And there's very strict laws in place about rebating. So it's very difficult to go to like a discount broker the way maybe securities work. It doesn't happen in insurance.
Don asks, is it recommended to have an umbrella policy?
It is highly recommended that you have an umbrella policy, because your primary and umbrellas cover third-party lawsuits. So, your liability, slip and fall, your management malpractice for your directors and officers, those policies will end after $1 million. And that's just not enough in the litigious world we live in. And dollar for dollar, what you get on an umbrella policy is probably the best value in the entire program of your policies or what you buy.
Right. A lot of people have asked a version of this question, and I think it's more relevant now than ever because of the amount of the increases we're seeing, which is, can we change our policy renewal dates to be 12/31 or 11/30, something that coincides with our budget year, so that we know what the actual rates are going to be? Some people say I have a 5/1 renewal, I have a 6/1 renewal. I want it to be 12/31, so I'm not completely in the dark when I do my budget. Is that possible?
Sure. It is possible. You have to, there are a lot of restraints. You're probably going to be locked into doing it with the current company, because most insurance companies have a provision in their policy that says if you cancel it and it's been in effect during hurricane season, even one day in hurricane season, they accelerate their earned premium clause. So there's not going to be any refund. So you're going to be locked into the current carrier. And in the current environment we're in, all you're doing is accelerating the rate increase that's coming your way. So it hasn't really worked out favorably to do that. But it is possible to do that. We have that come up a lot. But your flood insurance, and if you're with Citizens, you're not going to be able to do it, because they're just, they don't allow it. One thing I will say about not having a policy effective date concurrent with your calendar year or your budget year is, when we're in a market like this, it's going to ease the increase that you get. So if your policy is effective in June or July and your budget year is, calendar year, you're locked in until June or July at the current rate. So if you get hit with a big increase, you're only going to absorb a portion of that, a percentage of that, in the current calendar year. So your agent should be able to give you some idea of what to expect for your budget. But when it actually comes down and you didn't budget enough, you're not going to have to absorb the entire amount.
Right. I think you hit on this a little bit earlier, but how does increasing deductibles affect the premium costs?
The more risk you take, the lower the premium is. So you just got to be careful that you're evaluating it properly, and you don't want to get so caught up with having to reduce the cost that you've taken on the risk, and it just doesn't make sense to do that.
Right. Ronnie, I don't know if we really have an answer to this yet, but Ronnie asks, how will the milestone inspection and mandatory reserve legislation due to Surfside affect insurance? Have you heard anything related to that?
I mean, I think the inspections are going to give the insurance company another tool to be able to underwrite and evaluate their risk. So I think that's going to be a good thing, depending upon what's in those inspections. If that's going to reveal something that's not favorable to underwriting, then it's not going to work to your advantage. So I guess it can work both ways.
All right. Does having a new roof installed in the last year reduce the rate, or does it just maybe lessen the increase?
So it's going to create whatever available capacity is out there. You're gonna be able to perhaps attract some of that capacity that's out there, and the more competition in this limited market that you can attract to yourself, the better you're going to be. There are other factors, so depends on how much insurance you're buying, where it's located, how much risk that insurance company has in that area. But all things said, it does help a lot.
I think we throw around a lot of lingo sometimes. So you and I have been referring to D&O quite a bit. So a couple of people have asked, what is D&O?
Directors and officers insurance. So management malpractice, for the simplest definition as it is. I mean, think about all these directors and officers that are making decisions on behalf of the owners, hiring vendors, buying insurance policies, all the things that we do every day. And you have a fiduciary obligation to treat the money like it's your own. And if somebody makes an allegation that you made a bad decision and they sue, that's primarily what the policy is designed to cover.
Right. We didn't really touch on flood much. A couple of people have asked about flood coverage and what's happening with those rates and when is that required?
Yeah, FEMA's gone through a lot of changes in the last couple of years, and it has taken a real backseat because of the crisis that we have with property insurance. But most flood insurance is insured by FEMA through what's called the National Flood Insurance Program. Even though you'll have a private insurance company like Wright Flood or Hartford or Selective that issues the policy, it's all FEMA rules and all FEMA money. Highly subsidized for the most part. So rates are fairly stable right now. They went through a new risk modeling program, and for some associations, it has actually reduced costs. So that market is pretty good right now compared to what we're dealing with property, and hopefully it'll stay that way.
Right. Insurance company ratings, good question. How do they work, and how does that relevant to associations?
Oh man, boy, I'll tell you. I mean, many of you have probably seen the articles recently regarding Demotech and their desire to downgrade 27 insurance companies in Florida because of what's going on and them not being able to buy reinsurance. AM Best does not rate Florida domiciled carriers. So Demotech, company out of Ohio, kind of stepped into that role and did that. And now, they've wanted to pull because they felt like, hey, they're an independent third party, and it's created a lot of controversy because really we can't afford to downgrade companies and lose whatever capacity that is here. It's very, very delicate, but you won't see AM Best rated carriers in Florida writing homeowners insurance or condominium buildings. It's primarily Demotech rated carriers.
Gotcha. Let's see here. We addressed a lot of those. Someone's asking about, they're seeing 7.5 or 10% hurricane deductibles. Are you seeing deductibles that high in the market?
I am seeing it. I don't think it's the norm. Particularly, you'll see it in the non-standard or non-admitted marketplace. You will see that. I have seen it going into 2023. It wouldn't surprise me if we see more of it. But I think there's going to be some pushback from lenders on this. So the jury's kind of out on that. I'd be curious to see what happens next year.
Right. Okay. We addressed that. A lot of these are kind of specific here. How is replacement value determined when they're at the time of loss, like we've talked about?
Well, insurance companies use Marshall Swift type of software, which basically calculates construction costs. So oftentimes people are confused with replacement cost to market cost. They look at, hey, the units in here are selling for a great deal, but the selling price has nothing to do with the replacement cost. It doesn't include land. It doesn't include the desire to be in a certain area. It's strictly construction costs, labor costs, materials, and the cost to rebuild. And those have gone up with inflation dramatically.
Gotcha. All right. Well, I think there's some redundancy in here, and a lot of these are very specific. So I'd say at this point, we appreciate everybody who came out today. We try to answer as many questions as possible. I do want to be respectful of everybody's time. So if you are in need of an insurance agent, somebody with expertise in our specific marketplace, don't hesitate to reach out to Paul. His information is here. If you need guidance on these topics and are looking for professional management, please don't hesitate to reach out to us here at Campbell. And thank you everybody for coming today. Paul, any parting words?
Just real quick, the session, this emergency session that the governor called for insurance is going on right now. They started yesterday, and top of the list is this limitations on lawsuits. So I'll just kind of read you a quick blurb here. So proposed legislation right now would be to eliminate the requirement that property insurers pay the attorney fees of policyholders who successfully win and file lawsuits. It would end the practice of assignment of benefits. That's also a big thing, where if you hire a contractor and you assign benefits, then they can sue your insurance company whether you want to or not. It also allows insurers to offer policies that require the policyholder to engage in a mandatory arbitration process, which forces them into dispute resolution instead of a lawsuit. And there would be a discount for that. So these are the proposed things that they're dealing with. Top of the list should be to change that number that we talked about early on in here and make that 8% of the claims nationwide and 76% of the lawsuits to change that number. They're also proposing faster timelines. So now they changed it where the homeowner would have 1 year instead of 2 years to file a claim. Previously to the session they had earlier this year, it was 3 years. The insurer would have 60 days instead of 90 days to pay or deny a claim. Insurers would have 30 days instead of 45 days to conduct an inspection. So I think the thinking here is to speed up this process and reduce the amount of litigation that could potentially occur. Very difficult for these lawmakers to do something like eliminate rate increases because the market is so fragile. And if they do something like that and all these companies pull out, we're going to have nothing. Everything's going to go to the state. And that wouldn't be good. We need to create a competitive environment like we had. And we go back to that graph that you showed where rates go down, because we can return to that. It's just going to take time and it's going to take some reform. Right. So I hope that they do something.
I think we all do. We're all, whether you're a single family homeowner, condo owner, or business owner in this market, it's really, really hard on everybody. So,
but I appreciate you including me, and hopefully we covered some things that everybody can take back to their associations.
Yep. Very good. Thank you, Paul. Thank you for all those of you in attendance. Please don't hesitate to subscribe to our newsletter and blog, and we look forward to seeing you at future educational events going forward. Thanks so much. Have a great afternoon.
Thank you.
Thanks for watching. For more great educational content, click the subscribe button now.